Lee, can you hear me? No, you can't.
Okay, welcome to another edition of Florida Home Buyer with Brent and Lee. I'm Lee Brickey. This is Brent Starts with us, mortgage broker and extraordinaire.
That's great. Right. Good to be here tonight.
Yeah, so sorry we guys missed you last week, but we had a hurricane. So that was a little bit of a issue there, ran across. So we figured not to do a show because electricity was going off everywhere. So we're here tonight to talk to you about some really interesting information that Brent has to share. Mortgage rates have dropped a little bit. Looks like they're on their way down. We might be looking at the ceiling. So we're gonna talk about mortgage rates. We're gonna tell you a little bit about what the Feds was talking about a couple of weeks ago, and go over that and just give you a little information about where we see the market going and rates. So stay with us and let's get going. If you're coming in, tell us where you're coming from, say hello, and definitely ask questions, because that's what we're here to do, is answer your questions and let you know what's happening in the real estate market in South Florida. So with that said, let's get going. Brent, what's happening in the mortgage industry, bro?
It's been an interesting couple of weeks, Lee, that's for sure. Yeah, the last couple of weeks, we've seen a lot of volatility. We look at the 10-year Treasury as a guideline as far as where things, it's more of a rear view mirror where things have been. But this last couple of weeks, we've seen, the 10-year Treasury up to 4.5 and now back down today at 3.67. So a lot of volatility there. Rates certainly look like they've peaked out. That's kind of what we're seeing. We see inflation figures that were very encouraging last week. So that's really what sparked it. And then we see the, recessionary type of reporting coming out over the last 7 or 8 days. So since the election. So a lot of encouraging things. And of course, the situation in Poland now and Russia, that's geopolitical tensions are definitely high right now, right? So
right, definitely.
All that's kind of played into it.
Yeah. So do you think that, I know that the markets, I watch a lot of market news, obviously, and one of the big things that I'm hearing, is that, we're going to be looking at some gridlock here, and the markets love gridlock.
Mm-hmm. Yeah.
So they don't like one party having control. So
that's a great point, Lee.
The election, that's one thing that's really, I think the market's starting to move on that.
Yeah. And to explain to the audience what that means, the administration certainly has the executive branch, and now that the House is a Republican majority, it's going to be more difficult to get things through. And I think that the markets like it when there's, like you say, gridlock. They can't get things through. They can't screw things up. I think that's what we're saying here, right?
Right. One party can't just go ballistic.
Let's call it what it is, right?
Yeah. So the markets have been moving on that news, and then so that helps the bond market, right?
Yep, certainly does. Any type of uncertainty, right? There's things, as far as the geopolitical, bombs landing in Poland, that's a problem. And a
That's a
NATO
big
ally,
problem.
you know, it's a big problem. And so what they're doing is they're trying to,
There's somebody
keep.
crawling around on your floor.
I know I had problems with wiring, so we had a camera go down. I don't know, it's a much wider band today, so
Yeah.
we're getting it all sorted out. It's funny. He's leaving the office right now. He goes, "Man, I'm sorry." It's like he got me hooked up in about 30 seconds, and he's
It's good.
gone. So
It's
it's good.
good.
It's good. Yeah. So, did you ever see that video where that guy's on national TV and the same thing happened as kids walk in the room and the nanny
Oh,
comes
yeah.
in? That's
Yeah.
funny.
That was funny over COVID. All
It,
the newscasters from home and all of the glitches and funny things that were happening, dogs barking in the background, and
right.
it was entertaining, I have to
It
tell you. If
was.
there was anything that was entertaining about COVID, that was entertaining.
With technology, it's always funny, something happens last minute, about one every 5 times we do this,
Right.
something. Yeah. So that's good. But yeah, this last week we've had a lot of things, like you say, the geopolitical, those types of things, the uncertainty that brings, hey, is that going to draw us closer to involvement into the war,
Right.
Um, so Pam wrote, we both need your dogs.
Yeah.
we have Henry with us tonight.
Yeah. Yeah. He's under
Yeah.
my desk right now,
Is he?
snoring.
Yeah, I've
He
got
just
3
got back
dogs at the
from,
house now.
yeah. Do you?
I,
Yeah.
I,
One's enough for me, man. I finally got this dog straightened out.
there you
So,
go.
gosh, I've had so many problems over the summer. It's not even funny.
That dog
Anyway,
has a wonderful life. That dog has a wonderful life. You kidding
oh,
me?
he has the best life ever. He just
Ever.
went to Orlando for 4 days, and he'll be going back like 3 or 4 times over the holidays. So
Dog's more entertained than I am.
He gets to train. He gets to travel more than you do.
I know he does.
No.
Yeah.
So anyways, so let's get into it a little bit. Before we get into what's happening with the rates, let's talk a little bit about like forecasts. We've shown this before, but it's worth showing again because I'm thinking that this could happen now. We're seeing a little bit of relief here. So mortgage forecast for 2022, this came out November 16th. So it's predictions from Mortgage Brokers Association, Keller Williams chief economist, and National Association of Realtors. And they say that MBA says that an average of 5.5% at the end of fourth quarter and 5.4% at the end of 2023. So that's what we expect volatility in rates near term due to quantitative tightening by the Fed or other central banks as markets grapple with significant geopolitical, economic, and monetary policies uncertainties. And Keller Williams came out, and chief economist says this is the rates rising have continued to slow housing markets demand, resulting in slowing sales, slower home price appreciation, which is a good thing.
Right.
NAR came out. They think will be somewhere around 6% next year. There's a possibility of temporary decline of the news of consumer price inflation shows. So, and then Freddie Mac says that they're looking at an average of 6.8% fourth quarter this year. So, what do you think?
Yeah, I think, Freddie Mac, I think is right on as far as, somewhere in the 6.8 range fourth quarter. And I do think those estimates are pretty close to what I think is going to happen too. We saw, the highs right in the 7.25 range. And
Right.
so that was, and that
breaking the 7% mark, man. Boy, were we wrong, right?
Yeah.
Everybody was wrong. Nobody thought that we'd get here.
Nobody thought that, and we saw peak inflation pretty much in June, really. The month over months have come down, the most recent in October, is, much lower than what was anticipated. And that's always what happens. And that's why rates, move in such a strong way is when we expect high inflation still. And we saw a really nice number as far as the month over month in October of this year. So, and that's like a rear view mirror, by the way. So we've got a lot of high month over months that make up the year over year, right? And those higher months, the 0.7s, the 0.8s, they're dropping off, in that 12-year average or 12-month average rather. And so
Right.
we see, that's why we're seeing, and have a really nice low month over month. And clearly it looks like it's peaked because the month over months have just steadily gone down over the last 4 months. And so that's a great sign. And the 10-year Treasury, the bond market is really, the Treasury market is a rear view mirror, if you will.
Right.
It's not responding in real time like the mortgage bond market. But yeah, we've seen, the year of, we're at 4.5, in the 10-year Treasury. And, we saw a drop, today we're at 3.67. That's crazy. So, it's every quarter, by the way. So, once we broke through 4.25, it ran right to 4.5. That's just what it does. Traders place their bets and they kind of, they set their stop losses and all that stuff by the quarter. And so, it's 4.25 was the ceiling. Once it became, burst through that ceiling, now it becomes a floor, and it ran to 4.5%. And now we're down, we're at 3.75 last several days, and now it actually closed below that, which is a wonderful sign. We get a couple significant closes below 3.75, and we're going to see things go to 3.5, which is very encouraging for long-term, interest rates.
All right, so let's talk about what Jay Powell said last week,
Yeah.
because this is important for people to understand. So he came out first. It says, my colleagues and I are strongly committed to bringing inflation back down to our 2% goal. Okay.
Mm-hmm.
Then he comes out and he says, the determining pace of future increases, the target range, the committee will be taking into account the cumulative tightening of monetary policy. And this is where he went into talking about lags. So this is what you're talking about, the rear view mirror, because they're one of the things that they've been asked about is, are you looking at the lags, right? Because the monetary, they're moving faster than the economy can move itself, right? So it's a big it's like, turning a ship, it just takes time. So he talks about lags here, the lags with which monetary policy affects the economic activity, inflation, and economic and financial developments, right? So as soon as he said that, the stock market started going up.
Right.
Remember?
Right.
Then he comes out and he says this: the committee's assessment will take into account a wide range of information, including readings on public health, labor market conditions, inflation pressures, inflation expectations, and financial international developments. In the market just tanked right then. But with this being said, let's go backwards. So international developments. I mean, the whole world is in a recession right now, as we are. I mean, I believe we're in a recession. And the financial markets in the U.S. are taking a beating. I mean, we've had the stock market just collapsed. And then inflation expectations. I mean, everybody, we're seeing inflation, in some parts starting to decrease, but labor market conditions, I don't really know how they're going to react on that. We are seeing, though, huge layoffs in the tech industry. I mean, Apple put a freeze on their hiring. We know what's going on at Twitter. He's laying off a ton of people. So their layoffs are widespread right now. And
pretty much the whole technology sector,
whole technology sector, and the mortgage sector,
right?
And then public health. I mean, I don't even understand that one. I mean,
it's talking about COVID still.
Yeah, he's talking about COVID still, I guess. So, I just don't see 2% though without more oil and gas.
Right. You nailed it.
There's just no way to get there. I can't imagine getting below 4%.
And we're going to see, now that we've kind of we were burned through the strategic oil reserve too. That's going to decrease supply, and now we're going to see gas go back up. So
so we're going to see that inflation hit, which is you can't control. He said he can't control that. But one of the things that he did say at the end, that they can use their tools if they go too far, if they've moved too fast, to lower rates to bring the market back. But obviously it takes longer for things to go down than it takes for them to go up.
True.
But so this is a concern. I mean, no one can predict what's going to happen here because I don't see anybody being able to predict what the Fed's going to do. But this says that we're going to keep our foot on the pedal until we get to 2%. We're not letting up. I don't see how he can do it, though.
I don't either.
I mean, he's going to, because he did say he doesn't want to see. He'd like to take all the extra jobs out of the labor market because we have, a lot of jobs out there that are, need to be filled. So he wants to try to get those out. But he did say that he doesn't want to see, large layoffs. So I don't know.
He's in a tough spot. It's a tough spot, right?
Yeah, I think he is. I mean, I just, he moved too slow, in my opinion. He's moving really fast right now. But I don't see how they hold on to this more than through the first quarter of next year. But, I would say that, the holidays are going to really put people in a pinch by then, but people are spending money. I mean, that's one thing you did say. There's still a lot of cash in the market right now. And people have a lot of cash. They're sitting on cash. And then, you have, because they're out spending money.
Right.
I mean, retail's doing pretty good right now for the holidays.
It is. And,
they started this Black Friday sales early.
Yeah.
But I think people are going to come out of this with a lot of credit card debt. Credit card debt's rising right now.
It is. And it's to keep up with inflation. People are putting, things that they need, necessities on credit, that's a dangerous spot to be in. That eventually will snowball or could. So that's a serious concern. I mean, half the population would be set back with a $400 unexpected bill. That's tight.
That's tight. And then, with energy prices being what they are up north right now, I think we're going to get to a tipping point faster than the Fed's going to get what they want.
Right. Well, the futures market and the bond market, Lee, just so you know, it's good. Well, this is a good chart to pull up, actually. They're looking at, the futures market's showing the indication of a half point hike in the Fed funds rate in December's meeting. Yeah.
That's going to be Santa Claus is bringing that to town. Another 0.5%.
Yeah. Yeah. So that's just that's kind of baked into the mortgage rates right now. That's kind of what everyone's anticipating. And that's where all the folks that know what's going on are making those bets that it's not going to be another 0.75 hike because of the attractive, CPI that came out, for October. We've got another jobs report to come out, the first week of December. So we have another PCE, personal consumption expenditures report coming out for the next meeting. So there's a lot of, information coming out. We'll see what those, inflation and jobs reports, look like between now and then.
Right. So go over this 10-year Treasury rate sheet.
Yeah, here's what this looked like, just for last year. You're watching rates, go up, obviously, since January. And, you can see a couple spikes, in June, we a lot of people thought that might be a peak right there. If you look at that peak right in the middle of the graph there. And then we slowly went up, and then once it broke through that 4%, and then it just went to 4.25%, and then, actually closed up around 4.5%. That's when it turned back a couple times. You look to the far right, it was turned back a couple times right when it hit 4.5. And so, and it was a meaningful turnover this last week when that CPI index came out, and that's where you see that big drop, and then another drop. So, going through, 4.25 initially, then 4, and now we're looking like we closed significantly below 3.75. That would be wonderful if we have a significant close below 3.75. That's the market just screaming, hey, we've had enough. These rates are going to come back down because we see layoffs happening. We see a slowdown in the economy, less spending. And so that's what the bond market's saying. That's the bond traders that, obviously follow this all the time. It's not time to break out the party hats or anything like that, but it's certainly a great indicator of peak interest rates.
Right. So go over this chart.
Yeah. All right. This one I've got pretty much every day in there, but that big green candle, this is called a, Japanese candle chart is what this is called. And, the red days are down days. In other words, when the bond is going down, rates are going up. So you see over the last several months, you can see how the bond was going down, 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 rates were going up. And if you see that big green candle there, that means that's a huge swing. That day showed 209 basis points of movement in one day. In other words, the very tip top of it and the very tip bottom, the bottom tip was 209 points. And to give you some idea, a day where you'll see an intraday price change, in other words, new rate sheets come out with all the lenders because it's moved to such a significant amount that they change rates midday. You see that about 20 to 25 basis points. So in other words, about 1/10 of that. So that was a very big swing we saw last week. And then what's encouraging is we're seeing it stay up in that territory. We're not seeing it as a one-off. We're seeing that the traders are all looking at, hey, this is kind of the new normal. In other words, when you see a long candle like that, there's a very encouraging move up, which is down for interest rates.
Yeah.
Yeah. Anytime you see something that's significant, and
You
it
sent me
stays.
over this too. What's this?
Yeah. Oh, that's the first one I sent to you, the same chart.
Okay.
Sorry about that.
Guys, this is Brent's fault. You're just looking at a white
That's
page.
totally my fault. I sent the first one. It didn't pick it up, and then sent it in the second one.
So let's talk about in between time. So rates are high. We talked about this a couple of weeks ago when we had our last show that there's programs coming out. We didn't get a chance to talk about the programs. So we're going to talk about a couple of them now. So, what I want people to understand is, and I said this last week, is that prices are down right now because rates are up. So you're seeing inventory on the market, and we'll show you that in a minute, sitting longer than it has. But we don't have a lot of new inventory coming on the market because people aren't putting their houses on the market because rates are so high, and most sellers are 80% of sellers right now are at 3% or less. So
right,
they're not going to put their house on the market unless it's a forced sale. So there are programs coming out like this one, and I want everybody to understand. We've talked about this before, which is the 2-1 buy down. And I want you to explain this, Brent, and how it works and how the agent can help with this with the seller. So
this is great. This is a great program. It's called a 3-2-1 buy down. There's a 2-1 buy down. There's a 1-0 buy down. And let me explain what that is. When your rate is calculated, the standard rate is what it's called on this chart in the third line there. Let's say the market rate, just to grab a figure right now, let's say it's 6.5%. Okay. So what you do is, we look at that's your rate of the mortgage on the third year on. However, the first 2 years, there's a discount. In other words, the rate is lower for those first 2 years. Year one, the rate would be 4.5%. We calculate the difference in the savings there with that payment, that lower payment, and that would be a seller concession. Okay, so whatever that savings is, seller could credit the buyer to home back and cover that savings. Year two, the rate would go to 5.5% in that example. We'd calculate how much savings that was to the borrower in year two, and add that up, those 12 months, and add those two figures together, the savings in year one, the savings year two, and that would be the seller's concession or credit back to the buyer as an incentive to purchase the home. So now that Lee, you can probably speak to this more, but year and a half ago, 2 years ago, we were getting seller concessions all the time. The last 6 months, we really haven't seen that. But now that the market has softened up a little bit, we're seeing that that's an option, and where someone can still sell their home for what they want to sell it for, make that seller concession, helps the buyer get into a home with a much lower rate. And then after year 3 through 30, then it's the fully indexed, it's fully indexed actually. However, it's just the prepaid interest, basically the buyer's crediting I believe, and at some point in time, certainly in 3 years, there's going to be an opportunity to refinance, as rates drop
Right.
back down. So you could probably speak to the seller credit situation, what you're seeing out there right now. If that's
Yeah. So right now we're getting, so this one, in this example, year one, it would be on a $300,000 house at 7%. You would drop the rate to 5%. That'd be $4,632 that you'd need to buy down the rate. And then the second year would be at 6%. You'd need $2,364 to buy down the rate, which brings it to about $7,000. So what we've been able to do in the past, and what we're seeing right now, is not only are we able to negotiate price, but we're also able to negotiate seller credit, meaning
right.
that we could get a $10,000 seller credit, which would cover that on that house. Let's say we got 10,000, that would cover the seller credit for the buy down and leave you a little cash out. But depending on how expensive the house is and how much money we need, we ask for that on seller credit. So it allows the buyer to buy, but the house has to appraise. So the good news is here, you're buying a home for $10,000 less. You're negotiating the price down, so you're buying less then too, and the house has to appraise. So you're making sure now that you're getting a full appraisal and that you're not overpaying for the property, which a lot of people did. And that's why the market went up so fast, is because people were willing to spend an extra $10,000 to buy the home. Now you can get that $10,000 on a seller credit. So at the closing table, the seller is going to credit you $10,000 out of the price of the home. And we've done this, gosh, I can't even imagine. I can't even count how many times that we've done seller credit on VA loans. We've done it where we haven't even the buyer hasn't even had to put anything down. We've covered all their closing costs. So so this is a great program for people to use right now and to get the rate down to help cover the cost. What are you smiling about?
Yeah. No, you're right, Lee. It's a great way to negotiate, preferable situation for your buyers and sellers. It works for both. It helps them, get the lower payment that year or two. Most people anticipate some type of inflation-based increase in salary, that type of thing. So it helps, kind of ease that higher payment, that payment shock, going from renting to owning. But also, the opportunity to refinance. Like I say, if you look at where rates are in the last 10 years or so, with the recession picking up, all these, companies talking about 90% of all CEOs of large companies saying they're actively planning layoffs. That's in a plan. Yeah. And so now the elections are behind us. You notice all the bigger companies, especially tech companies, they all come out basically saying, hey, you know what, we've been kind of putting this off, you know what I mean? And now we're serious about making some cuts. So I think we'll see. It'll be interesting. The jobs report will be interesting here this next few weeks.
I just think there's so many jobs out there that you're still not going to see much of a change in the jobs report. I don't see it happen.
It's interesting. It's really, you have to really parse the numbers, because there's so many people have two jobs now, to keep afloat, right? They're taking part-time jobs, or they're doing side hustles, cash gigs, that type of thing. So, it's interesting. Bartering is a thing.
So, you listen to all the YouTubers that are real estate agents, and you hear a lot of doom and gloom out there, in this recession. And I don't see the doom and gloom as much as everybody else does. I see the pinch on people. Obviously people are being pinched right now, and they're financially, and they're filling in their pocketbook. I mean, we're filling in our pocketbook. But if you have the money right now to purchase a home, 3.5% gets you into a nice home still. I mean, the FHA, what's FHA now, Brent?
What, the 3.5% down? It's
probably, how much can you find it?
Yeah, and the rate's probably in the, you're in the low sixes now.
Right, so you can buy that down, and then how much home can you buy now in Palm Beach County and Port St. Lucie?
Oh, in the 450 range now, so it's there.
decent house, right?
Yeah.
So if you have money to purchase, right now prices are down, and prices are down substantially, I would say, at least a 5%. Some markets, I would say you're looking at 10%. But one thing that we are seeing is we're not seeing the crazy numbers anymore. You're not going to get crazy numbers. So sellers aren't going to get these outrageous numbers that are over appraisal. The house is going to have to appraise for them to buy it. Because the buyers that are buying now are going to, the lenders are going to want to see appraisals. So you can wait and not buy if you're in the market to buy, but if rates go down, we're going to see the market go up. So let's just look at the national graph right now. So this is up to October, and this just shows listings, active listings and new listings, and you can see from June, active new listings are dropping nationwide, where active listings are going up each month. So homes are sitting on the market and sellers are trying to sell them. All of these are forced sales. Somebody passed away, somebody's going into a nursing home, they got a job in another state. That's what you're seeing. The properties are sitting on the market longer, meaning that there's more ability to negotiate, but the market is staying very tight, because you can see as the homes sit on the market, listings are going down. So it's keeping the market tight. So in the foreclosure market, if a house goes into foreclosure, they have so much equity in it, they're going to sell it and get the equity out of it, because that's what they need, is money if they're going into foreclosure. So if somebody does lose a job and they can't afford their home anymore, they're going to sell it.
Right.
Because if you've been in a house in the last 2 years, you're sitting on a ton of equity.
Oh yeah.
So, and then when you look at this, you can see the housing supply is still historically low.
Yeah.
I mean, we're looking at, a low, I mean, we have very little inventory still nationwide. And if you take that into account with Florida, I mean, we're expecting 600,000 people to move to Florida over the next 2 years. So we got 300,000 this year. We're going to get another 300,000 next year and another 300,000 the year after that. So
not enough roofs.
Not enough roofs.
I
mean, listen, we went through West Palm today, and I went to Fort Lauderdale, came back from Fort Lauderdale, went through West Palm, and the amount of construction in condos and townhomes is unbelievable in Fort Lauderdale and West Palm Beach. It's unbelievable. I mean, they're just building everywhere. And in places that, were lower income, I mean, they're tearing these houses down or rehabbing them if they're historical. So, I mean, it's incredible the amount of real estate and how these little small neighborhoods are changing over, because they're just ripping houses down and putting new ones up. And some of these people have been in these neighborhoods for years, living there 10, 15, 20 years. And, the value of those houses are going to continue to go up, because the land, and the more expensive the property value gets, it comes to a point where if someone's in that neighborhood and they're lower income and they're ready to retire, they're going to sell that house because their property is worth more than the home is. And that's how these communities continue to grow.
Right.
But South Florida, it's incredible the amount of construction going on right now, and the high rise is going up.
Right. The construction permits, multifamily is way up, and compared to, what I mean? Single family, compared to historically. And that's, 12 million households are being formed a year now. These baby boomers, they're not baby boomers, echo baby boomers, the millennials, they're forming households. They've been held up, for a few years. Now they're out there setting the world on fire. So it's good stuff.
Yeah. I just got an email on that today. Let's see here if I can find it. Yeah. So it says that millennials account for more than, this is my email. I just came in today. So it says millennial ages 26 to 41 are no longer just demographic segment. They are now a biggest demographic segment in the U.S. and make up the largest share of all home buyers. Millennials
Right.
account for more than 40% of first-time home buyers, and recent study found that 71% believe home ownership is a good thing. So
Yep.
there you go.
Yep.
So
That's the low end stuff, the entry level stuff. We're going to see more of that, and the baby boomers that are downsizing. So
right,
that's two large markets right now. So we'll see that multifamily continue to grow.
right. So what other programs you think will be coming out here to make it easier for people to buy?
Yeah, the 3-2, it was a 2-1 buy down. Now they brought the 1-1 out. The 1-0 and the 3-2-1 now. So actually, you get 3% lower than the initial the start rate. So so all those programs, we knew they'd start coming out. They started coming out about a month and a half ago, and now we're seeing them expand. That's going to continue. The other thing we'll start to see, typically is what we see is a spread on the short term money. So adjustable arms coming out. Right at this point, it's not there yet, where it doesn't really make sense to look at a 5-year arm right now, adjustable rate mortgage, and sometimes that does come into play, but we just haven't seen it yet. I'm still keeping an eye on it, but the 30-year, the 15-year, if you can afford the payment, those are still the routes to go. But I look to see adjustables coming back at some point too.
Right. When do you think we might get out of this, Brent?
Well, I'll tell you what, the thing that you kind of look at what's the Fed saying and what do they really mean? And it's, obviously I think everyone knows, and I think the Fed themselves know that they're playing catch up. They started late, right? As far as,
Right.
Printing all this money and then, flooding the economy with it. And then, saying it was transitory, of course, that's really going to cause inflation. And so, I think, a little late to the game, but I think now that they, they're really putting their foot on the gas. They're a little behind the game, but I really think that now they're concerned about not overdoing it too. And those reports are going to be telling the next 6 weeks, we're going to see some things that those, like say, the jobs report is going to be huge. They want to see, lower employment, to some degree. They've hinted to it now, and they've come right out and said it. So, I don't know how they're going to do that without, getting inflation to 2%. If that's really their goal, without solving the oil issue, it's going to be very difficult. That'll be really painful.
Right. Right.
Yeah, but I think I'm encouraged because I think we've seen quite possibly, like I say, don't bring out the party hats yet, but quite possibly we've seen the peak in rates now that the recession information and larger companies openly actually doing hiring freezes and layoffs. So we're seeing it, and so
And
I
a
think
lot of market professionals think that that we've really reached peak inflation too. I'm hearing that a lot on the business channels. That hearing that from the Wall Street Journal, and a lot of Wall Street analysts are thinking that, hey, we've kind of peaked out on inflation here.
Yeah,
I think gas prices can go up though, for sure.
they can. And that's a supply and demand thing more. And
Right.
if we're cutting supply, then of course the prices are going to go up, and that's unfortunate. But yeah, as far as the peak inflation, the last 5 or 6 months, the month over month figures have gone down every month. That's a great sign. So and then the October figures were the most encouraging. They came in 30-40% less than what was anticipated. So that was a very good sign. And as those larger month over months drop off, the last 12 months ago, that last high of 0.8 drops off at 0.9. That's going to be very helpful, to the year over year, and kind of allow some breathing room for the Fed to get off the gas, as far as the rate hikes.
Well, I don't think, I listened closely to Jerome Powell, and it doesn't seem that he wants to hurt the American, economy too much, and he doesn't want to unemploy too many people. So
right.
we'll see how that rolls out. But if we don't have any questions and you don't have anything else to say, let's wrap it up.
Sounds great.
All right. So thanks for joining us this week. We'll be back next Wednesday, same time, same place. And if you have not subscribed to our channel, go ahead and subscribe to the channel so you don't miss any of our real estate tips and tours. We'll be putting out videos this week, and Brent is putting out videos every single week. And so make sure you check out Brent Starts at Unitas Lending in his channel. We appreciate you guys joining us. We really do. And we thank you for coming on our show and listening to us every single week. Hopefully we're supplying you with the right information. If we are, give us a thumbs up. We really appreciate it. Leave a comment and be kind to each other, and we will see you next week.